So is the market downturn over or just beginning? Well, obviously right now we have a lot of geopolitical issues, have to put that into consideration. But all that being said, it doesn't change our process. The data drives our decisions. We know that growth is slowing. We know the Fed's going to start raising rates in March. That is what is called a policy mistake, okay? Raising rates, growth down, not good for the market. So good thing is we got a lot to discuss today. We're going to go through where we are in the cycles, what the charts are telling us, where we're investing, and game plan going forward. Let's go. Just like we have 4 seasons, we have 4 cycles. Made the move, the call to cycle 4 in late December. Had a great cycle 2, growth, tech, you name it, everything was working there, inflation assets, but things are changing, and cycle 4 is not a good cycle for the equity markets, okay? Growth is going to slow, inflation decelerates. I am not saying inflation is going away overnight. On a rate of change, it should slow down. That being said, have a lot going on right now in the geopolitical landscape, so that could change, okay? Right now, GDP now, this is Friday, came out, the Fed, going from like a 1.5 projection for the first quarter to a 0.6. If oil goes higher, which it looks it will, that number is going to go lower. The other thing is the Fed is projecting a 2.8 for the year. No chance that happens. I can tell you that right now based on our projections. Let's go to the big charts. All right, first up, we look at the markets in 3 different areas. 3 weeks or less, 3 months or less, 3 years and less. Okay, here's your monthly chart. As of right now, we are below the 12-month moving average. That is not a good sign. The other big thing is, because this is the last chart that has stayed above, okay, meaning me not calling a negative signal yet, momentum. About ready to have a negative momentum crossover. That is not good for the market. But today, as I record this, okay, we're looking at a neutral call. We'll see what happens going forward. Next one is your S&P weekly. We have definitively had a negative turnover down here in a big way. Okay, so midterm, we are also negative. The next one is my S&P 500 daily chart. Been calling this my most important chart that I'm following right now for a lot of different reasons. Okay, a couple things that when I look at this, one is relative strength at the top. Okay, we peaked over here. The market went up, but it was going lower. So that's called negative divergence. But then we continue to see a series of lower highs on relative strength. That is not bullish by any stretch of the imagination. Volatility down here has stayed elevated, okay? The next thing is I have what's called the Fibonacci on here, retracement. I will have a video link up there for that one, okay? We broke our key support the other day. We were right on it, all right? And then we had a surge back up. Not surprising, kind of a counter trend, bear market bounce, okay? Was not done with a lot of volume, as we'll talk about. So one of the things right now, as I record this Monday, 10:30-ish, okay, market's down about 0.85%. How can that be with everything that's going on? Because I will tell you, I'll have Andrew put up a chart here. Last week, Wall Street, the big boys, hedge funds went all in. Futures contracts surged last week. So right now in the morning, you're seeing a lot of those contracts, okay, being unwound because they're upside down. Keep in mind, hedge funds are down 9.5% year to date. They've got some chasing to do. They chased last week, and with what's going on, it is hurting them in the short term. So we'll continue to watch that. But the key level here, 42.21, if we break that, it brings out a whole nother new Fibonacci number to the downside. Okay, next is the NASDAQ. NASDAQ has fared worse. Okay, the most important thing here, we've had the dreaded death cross. 50-day going over the 200-day moving average. Not a lot going on here. Not a good looking chart. Tech high beta is not the place to be in the fourth cycle, okay? Next up, let's take a look. It'll show you NASDAQ relative to on a performance basis. This goes back to 2001. We broke above that, obviously, and now we are back below it. So that does not show a lot of strength for the NASDAQ as well, okay? So next up, sector spotlight. All right, sector spotlight. Let's start with the dollar. As I always say, you get the dollar right, you get a lot of things right. In cycle 4, dollar goes up. Now this does not update, okay, in real time. This updates at the end of the day, but we had our bottom here. We've gone up nicely. Today we're up as you would expect with a lot of things going on in the geopolitical landscape. So dollar is something I like going forward. Next is your 10-year treasury, okay? Right now we're down about 5.69% here. That is a big move to the downside. Treasuries do well in cycle 4, but we've been waiting patiently, okay? That pain trade hasn't come yet. You're seeing it on days like today, big news days, but once the Fed starts raising rates, we feel you'll see more of a flight to quality, which is where the bond trade is definitely going to become in vogue, if you will, okay? Next up, consumer staples, not having a good day today, okay? But it does do well when interest rates are down. But that being said, in cycle 4, deep if we get there, this doesn't work either. We'll probably sell this. That's another reason we have not taken a big position here. The next one is utilities. Utilities is up a little bit today, okay, based on all the volatilities. Another asset class that does well when interest rates are going down, okay? Interest rates, not Fed rates, okay? Next one is gold. Pretty simple. I'm either in or out. Gold doesn't have earnings, doesn't have dividends. So in or out. Now you can look at this chart and you can see in or out. That's based on the 50-day moving average going above or below. So either a golden cross, we're in, or a death cross, and we're out, okay? Right now, as you can see, we got the signal to go in a little while ago. And when I'm looking at gold, you're up today. Not surprising, based again on a flight to quality, okay? You can see this trend line here, okay? And we broke that. That's called a breakout above a trend line. That is very bullish, okay? We do like that. The other thing, when you look at down here, okay, down the bottom of the chart, we're showing gold relative to the S&P. All right, you go back to December, you can kind of see it's had a nice slow grind higher versus the S&P, meaning it's outperforming the S&P. So again, that is something that we like as well. Next up, what keeps me up at night? All right, first up, no surprise, the Fed. Here's a bunch of headlines in the last week. Despite what's going on right now, they have to raise rates because of inflation running so hot, and it's only going to get worse based, again, on what's happening today. Now, there's talk of not being a 50 basis point raise. It's going to be 0.25%. No matter what, it's coming, okay? So it's coming, and as we talked about, growth is slowing. That is not good. Take a look at 2018-19, the Fed were raising rates, growth was slowing. And then, of course, we had the famous Powell put, okay? Next up, our process, what is our goal? Is to avoid the downturn. So if you like what you're hearing, okay, make sure you subscribe. You can also comment below. This shows a drawdown. The blue is the S&P, and the orange is the Qs, okay, the NASDAQ 100, okay? Max drawdown for the S&P is 56%, 63% for the NASDAQ. Not saying that's going to happen, okay? But if you go to 2008, a 60-40 portfolio was still down 38%. There's a lot going on right now, okay? But this is about risk management. Our process is about risk management and avoiding those downturns, okay? Another big chart we're looking at, high yields, credit. The credit market is starting to dry up. That's a big issue. We've had a breakout right here. You can see it. As that's broken out, high yield ETF is breaking down. Have to watch this one very closely. Next one, New highs minus new lows. In blue is the NYSE, so the full market. Friday, we had a big day, right? New highs minus the new lows, 29. That's it, okay? No strength. We're not seeing that push to the upside. Until that changes, which I don't see happening, okay? We're going to continue either in this little cycle here where we are, kind of stuck in nowhere, right? Or continue to break down. Next one is S&P going back to 2007, below the 200-day moving average. The longer we're below that, the longer bad things happen. You can look at that in other periods here. 2020, 2018, 19 we talked about. 2015, 16, remember that? That was about a 24% pullback. And then, of course, 11, 12, that was some of the Brexit and some other things. And then we have the 07, 08 crisis, all right? Last but not least, yield curve. Again, one of those really important charts right now. 10-year Treasury minus the 2-year gives you the yield curve. This is your number one recession indicator. It is crashed. Okay, we hit a cycle low, 0.38. Didn't get the number this morning. This doesn't update till the end of the day as well. Okay, right now, based on those numbers, it's telling us a recession is coming within 6 months. Some articles I read this weekend are saying that's what the Fed is looking for because all at once they can get rid of the the inflation issues and everything else. But too much going on right now. We'll see. More to follow. Next up, game plan going forward. All right, first up, follow us for updates. Always putting information out there, Facebook, Twitter, etc. Link below, okay? Right now, we're pretty much neutral. We're not all the way in on our Cycle 4 assets. We've got more cash than normal. Definitely not holding high beta right now. We're neutral, waiting for a definitive line. As I said, 42.21 on the S&P. So that breaks, holds, then we do some other things. Talked about some hedging ideas, buying the VIX. We put our first hedge on Friday. Just did a video on that. You can take a look at that right here. The Fed behind the curve, right? Raising rates when growth is slowing. That is not good. Watching that yield curve. Transitioning to Cycle 4 assets, okay? And then also opportunities. You have to be smart. If you're still holding some high beta, sell on strength, on green, okay? And if you want to add some of these asset classes, you add on red on down days, okay? And build those positions. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.